AI adoption in banking and asset management has by now moved well past the experimental stage and is firmly embedded in banking operations. Consider the UK, where some 75% of firms reported using AI as far back as 2024, and another 10% plan to do so within 3 years. The European Central Bank (ECB) reported this year that more than 85% of significant banks under European supervision use AI. In asset management, Mercer found that 91% of managers were already using AI in investment strategy or asset class research, or were planning to do so. The World Economic Forum projected financial services AI spend rising from $35 billion in 2023 to $97 billion by 2027. But while the depth of adoption is apparent, deployment of AI is uneven. Banks are using AI most heavily in operations, internal process optimization, cybersecurity, fraud prevention, customer support, and coding assistance. There is much less evidence that AI is being deployed to make fully autonomous decisions. Looking again at the UK, a 2024 Bank of England report found that 55% of all AI use cases have some degree of automated decision-making, with 24% of those being semi-autonomous, meaning that while AI models can make a range of decisions on their own, they are designed to involve human oversight for critical or ambiguous decisions. Only 2% of use cases have fully autonomous decision-making. The same report found that some 62% of all AI use cases are rated low materiality by the firms that use them, with 16% rated high materiality. Given that background, it's clear that competency in AI is already a key factor in bank recruitment. But hiring patterns indicate that while banks have keen requirement for broad-based AI literacy, this is not at the expense of domain expertise and strong capacity for judgment. It would seem the banks are aware that overemphasis on AI fluency at the cost of underweighting banking, prudential, conduct, fiduciary, and market structure knowledge is an acknowledged risk, and that the human factor remains critical. This principle is reinforced by regulators who are explicit that human judgment remains essential wherever accountability, ambiguity, duty, fairness, exceptions handling, and severe downside risk are present. The European Securities and Markets Authority (ESMA), for example, emphasizes that management remains responsible for an organization's decisions, regardless of whether they are taken by people or made by AI-based tools. In the U.S., the Office of the Comptroller of the Currency (OCC) observed in 2026 that banks' use of Gen AI and agentic AI remained largely limited to guarded use cases with human-in-the-loop accountability. The UK's Financial Conduct Authority's (FCA) current stance is to rely on existing conduct, governance, and accountability rules rather than to create an immediate AI-specific rulebook, while using tools such as AI live testing to develop evidence on safe deployment. The pitfalls of reliance on AI without the safeguards of informed human judgment are clear, illustrated already with numerous examples of embarrassing and reputationally damaging incidents, to say nothing of financial loss. Educators have expressed deep concern on the effects of AI on the educational development of young people. By extension, as banks automate more analytical and operational work, they risk hollowing out the very domain expertise that used to sit inside those tasks. At the same time, many employees entering banking roles may have strong communication, leadership, sales, and client skills, but limited financial services domain knowledge. That creates a dangerous gap. People with increasing decision-making responsibility may be relying on AI-generated domain insight without having the knowledge needed to question it. AI has an unprecedented ability to process information, summarize data, and, under certain conditions, make recommendations. But in banking, the human still owns the consequences of the model's actions, which requires judgment. That judgment depends in turn on domain fluency. The traditional banking competencies, such as understanding balance sheets, credit risk, portfolio concentration, client exposure, regulation, and the knock-on effects of decisions across the bank. Yet, while the risks of knowledge-light, AI-heavy decision-making are clear, the dramatic synergistic benefits for those who can complement banking domain knowledge with AI literacy are immense.